Hello, it's Mr. Intermarket Analysis bringing you a review of US light crude. Okay, so this is the chart of oil. Okay, so where is oil going? Basically, just going to review that. Obviously, going into Monday's trading, the 25th of November 2013. Okay, so let's start by saying happy birthday to me. Happy birthday to me. Okay, I'm 31 today, getting old. Okay, folks, I need to start investing in a walking stick now. Getting grey and old, and okay. So yeah, I need to start oiling myself now. My right finger that I keep clicking and moving with regards to the mouse, that's creaking as well now. So I'll have to put some WD-40 on there. Okay, just getting old and creaky and. Yep, just went for a run this morning. Thought I'd try and revive my youth, okay, and just did some reflection. It's unbelievable how time flies, unbelievable. Just the other day I remember being at university and enjoying life, and now wife, 2 kids, and full-time trading, mentoring, running the live analysis service, hopefully starting a fundamental analysis service from January onwards, and there's a lot of other projects that are coming down the pipeline. So amazing, obviously YouTube as well now, and Twitter as well. And I used to be really antisocial, well, not antisocial in that sense. Obviously I tend to go out and about and enjoy myself, but with regards to the social websites, etc., anti-Facebook, etc. But obviously I've changed. I'm more of an old school type of guy, hence the reason why I like intermarket analysis. It sits well with me, more old school. This is how the traditionalists and the elders used to trade, based looking at multiple variables, multiple time frames, etc., and trying to fit the jigsaw puzzle together, because it's a challenge. Day trading shouldn't be reliant upon some dodgy indicator, okay, or some moving average, etc. It's reliant upon several variables that obviously come in concert, and once you learn to play the piano like I teach my students, everything becomes easy. Initially, obviously, you need to learn note by note, and eventually you become Beethoven and you can close your eyes and play the piano, and that's intermarket analysis. Okay, folks, let's go back to the oil chart. Okay, so we've had a bearish channel here, and this is the daily chart of oil, by the way. We have a bearish channel. As you can see, we've broken through the smaller downward sloping trend line. We had a channel here. We've broken the smaller micro channel, then on the verge of breaking the macro channel. Okay, so focus on that, folks. Obviously, if you just scroll back here, you've got a lot of horizontal support which we've held. We've had a bullish engulfing candle. Okay, we've got an inverted head and shoulders formation now. So 95.75 is a neckline. The head is 92.75. If you project that to the upside, it takes us to the 200 MA or horizontal resistance, or previous horizontal resistance. Okay, so watch out for that. So upward target, provided we obviously I'll discuss the fundamental catalyst in a moment. Let's just focus on price action purely for now. Okay, so obviously we've got a right shoulder forming here now. We've got a bull flag formation because we've consolidated within the green candle. So obviously the bulls have certainly held this level, and now we're looking for a catalyst to break out and obviously propel this market higher and trigger off the inverted head and shoulders formation. Okay, so that's the macro view. Okay, inverted head and shoulders on the verge of breaking a bearish channel. Okay, so watch out for a short squeeze there. Now let's look at the micro channel. Okay, let's give you the setup on the micro channel. Okie dokie then. So 60-minute chart we've got here. Okay, again 60-minute replicates the inverted head and shoulders formation like you can see here. Okay, we've got a bullish channel, the 2 red lines here. We've got a bullish channel projecting the market higher. The first level of resistance, watch out for this gap level here around the 96.25. Okay, watch out for that. And the next level will be the 200 MA. Watch out for that resistance. And then you have a gap up here. The ultimate gap really is 98.2, which again coincides with the inverted head and shoulders target. Surprise, surprise. This isn't. I understand the fundamental traders out there call us, magicians and voodoo and witches because we use TA. Respect to them. Obviously, I understand. 89% of the market out there are fundamental traders that probably never even look at a chart. Okay, but obviously that even they have to accept now, and obviously the tide is turning, where they are adopting technical analysis. Even the Federal Reserve, there was a link that I gave based on Mr. Murphy's work where they used inverted and H&S formations and realized and accepted that yes, we agree that these patterns do actually play out and they have a high degree of success, to the point where they actually had to employ chartists and technicians to actually make their policy decisions, okay, or factor in to a certain extent their policy decisions. So technical analysis certainly works, chaps. Okay, so provided you utilize the correct form of technical analysis. I understand there's Gann theory, Dow theory, Elliott waves, etc., and I don't want to be anti alternative theories out there or alternative schools of thought. I think I've already aired my opinion what I think of those. Very subjective, too subjective for my liking. Okay, even technical analysis is so subjective. It's subjective science. Okay, and as traders we need to approach everything as objective as we can. But it certainly gives you the momentum in terms of technical analysis, provided you follow the simple concept of higher highs, higher lows, the bias change principles which I teach, bias change principle 1, 2 basically, and based on higher highs and higher lows. That's it, literally all the what we're stating here. I mean, to look at this example for now, this level here, dotted line, is horizontal resistance. Okay, whenever the bulls have tried to break above it, they failed. They've had no sustained move, and obviously you had a massive red candle and we sold off. Okay, so it's certainly a level to hold. Once this level breaks, the psychological level where all the bears out there, okay, or even the bulls, if they're selling the market up here, they'll continue to hold their positions and even bid the markets higher, expecting higher prices. Okay, so basically creates a short squeeze. Okay, and obviously causes a psychological shift in the markets, and the markets move in the opposite direction, which is higher, obviously, and we make new highs. Okay, so and then obviously it brings in new believers, people with higher expectations, etc., because it's broken a technical level. Okay. Righty then, so basically, yeah, watch out for that inverted head and shoulders formation, your bullish channel. I mean, I'd certainly go for the 97 first of all, and obviously 96, 96.5, 97.5, keep an eye on those two levels, okay, and obviously the gap level above, okay, folks. So I think that's a nutshell with regards to technicals. Now let's look at fundamentals. Okay, what can cause this to move higher? Now the slight concern I have with regards to fundamentals is the number one, tapering. Okay, that increases the US dollar index. Now, the concern with the US dollar index, obviously, yes, we've broken the downward trend line. Okay, we're now on the verge of obviously breaking higher. Okay, so you can clearly see here we had this wedge type pattern, down sloping wedge, contracting wedge, and obviously we've broken and propelled higher now. Okay, so that's certainly a bullish chart. Okay, on oil. So sorry, US dollar index. This is a US dollar index, folks. Okay, so US dollar index. So this is breaking higher. So basically, commodities move inverse to the US dollar. Therefore, if US dollar moves higher, oil will move lower. So that's a conundrum. Okay. So how can we say oil is going to move higher? So the only way oil moves higher now is based on geopolitics. Well, yes, we've got tapering. Now the only thing that I've noticed here as well, though, is if Miss Yellen, given the fact that she's a super dove, you know what I think of her, absolute nutter. Okay, but if she does, I mean, we have failed the inverted head and shoulders because we've broken below the neckline. So as we all know in technical analysis, a failed pattern equals what? An emotive move in the opposite direction. So therefore, we could go back and test this low again, which again helps oil inflate. Okay, and causes oil to move higher. US dollar index moves lower. Okay, given the fact that inflation data last week was pretty tepid, although we've got no growth catalyst. So that's the problem. Okay, with Chinese plenum, with the US relatively weak, with the Europeans weak, where do we go? So that's another conundrum. Okay, so the US dollar really, it can move higher, and obviously we've closed the gap here, we've held that resistance, we can go to 200 MA, and obviously we can move higher to this ultimate gap up here. So if this moves higher, obviously oil prices will move lower. So that's, like I said, that's a conundrum. If this this pattern, inverted head and shoulders pattern, has failed and we do start to move lower on the US dollar index, then yes, we will. Equity markets will inflate higher, and obviously oil commodities will start to inflate as well. Okay, and I'll discuss that and elaborate that more on my FTSE 100 weekend analysis as to the equity side of things. Okay, so obviously the US dollar index, let's just take that out of the equation now, because obviously commodities are related inverse to that. So then the next thing that will move higher will be geopolitics, because growth isn't there. Okay, growth is certainly not there. Okay, the US dollar index certainly looks bullish so far. Okay, so therefore oil will move inverse, so it will go lower. So what catalyst can we move or propel oil higher with? Will be geopolitics. So watch out for geopolitics next week. We've already heard about chatter about the Saudis and the Israelis colluding together to hit Iran. We've already seen talks of not totally breaking down, but there's still no deal reached with regards to the Iranian situation. With regards to nuclear talks there. So any breakdown there, any sort of chitter of any sort of friction, etc., then certainly watch oil to propel higher. Okay, but if we do get some data with regards to economic data being stellar or being better than expected, or growth forecasts raised, even though OECD did lower growth forecasts, okay, then yes, that's another catalyst for oil to move higher. So watch out for the catalyst. Technically we're set up, we just need a fundamental catalyst, and off we go. Okay, risk on, risk off, wax on, wax off. Goodbye now.